And what I want to talk to you about today is the 401k nightmare. Do you really know what you're getting yourself into? So I'm going to make a deal with you. I'm going to loan you some money right now. I'm going to write you a check for $100,000. And here's the deal. You're probably going to have some questions. And the two questions that are most commonly asked when I make this offer is, when do I have to pay it back? And what rate do I have to pay it back at? What's the interest rate I have to pay? So if the deal went like this, I don't really need the money right now, so I'll let you know when you have to pay it back. And interest rates suck right now, so when it comes time to pay it back, I'll tell you what the interest rate is. Would you borrow that money? And I have yet to have a person tell me they were actually going to borrow that money unless they were making a joke about it. They're going to die tomorrow and not pay it. But most people would never borrow that money under any circumstance, and I believe you wouldn't either. So I want to explain to you how the 401k actually really works. Now, what you have here in front of you is what we call our personal economic model. And if you've seen me use the personal economic model, you understand that money basically comes down this big tube over here, hits this tax filter, and then it's consumed and gone forever. But the way we bypass this tax filter is what we do is we put money through this tube over here and we contribute it over into our 401k. Now, for most people, when they look at that, this is what they believe is going on. They believe that they're just contributing money over into that account and it's getting the gains of the market and the losses of the market, and they don't have to pay any taxes. And they don't. They don't have to pay any taxes today. Because you see, they're taking and they're deferring those taxes out to a later date. Now, they believe that all that money in that account belongs to them. But that's just not true. The IRS sees their plan just a little bit differently than they see it. And the way the IRS sees the plan is they place a place to put taxes for the future. Now, the interesting thing about that is that it's actually against the law for the government to invest government funds in the stock market, yet they found a way to do it. And the way they found to do it is they got you to do it. So they said, look, you can defer these taxes, and most people, not all, but most people will take that money, they will invest it in stocks, bonds, mutual funds, securities of some type, and try to get the gains of the market. And they will take on the risk of what that's all about. And in addition to that, they take on a second risk, which is the taxes at a later date. Now, the money they place in the account is theirs, not yours, is the way the IRS sees it. Yet you see it as your money. You see it like this, and they see it like this. And this button here is controlled by the IRS, and it determines how much money you're actually going to pay out in taxes. That right there should be enough to scare you out of doing this. But when we go back and we look at what a qualified plan actually does, is it does two things. It defers the taxes, and it defers the calculation out to a point in time where we really don't know what that rate is going to be. But what it really does is it postpones the taxes and postpones the calculation out to a point in time where we might believe that it's going to be lower. Because after all, that's what they've always told us. You should put your money inside of a tax-deferred account because you're going to grow on money you would have otherwise paid in taxes. And in the end, you're going to have more money because you're going to be in a lower tax bracket. Well, the thing is that that's probably not true, okay? Because if the future rates are lower, you'll have more money. But if the future rates are higher, you'll have less money because you'll have to pay more in taxes. So let's take a little look at, the tax thresholds over the years. Since the inception of the temporary income tax and the establishment of the IRS in 1913, we're here from the government, we're here to help you, all the way out to 2022, our rates have looked like this. Our top marginal tax bracket started off at $7,000, 7% rather, and $20,000 lowest tax bracket. And if you look out here, it went as high as 94% with a threshold of $2,000 lowest tax bracket and top bracket at $200,000. And currently today, our top marginal tax bracket is 37%. That's on $647,000. And it's $20,550 at a 10% low rate. Now, if we look at that going forward, then we would look at the tax history on a chart that looks like this, and we would see our average has been 56.94%. Yet we're sitting out here at 37% right now today. And I can remember back when I was a young kid, my father used to say he's not going to work today because if he went to work today, he would pay all the money out in taxes. And I thought he was absolutely nuts. I thought, what could he possibly know about that? But as I began to learn about taxes, I realized that when he went to work, if he went to work that day, between his state and Fed, he was going to pay out over 75% of it in taxes. He was only going to take home 25% of what he made, and he just didn't see that as worth it. So if we look here, we have a national debt that's $31 trillion. That's with a T. And if I was to take $1 trillion and I was to stack it here on top of my desk, it would go around the earth twice. It's a very big number. We have a national budget of $4.6 trillion, but we spent $6 trillion. We spent $1.4 trillion more than we brought in. Our unfunded deficit down here for Social Security, Medicare, and prescription drugs is $182 trillion in this right corner. So we're basically $213 trillion upside down with a $4.6 trillion budget. If we didn't spend a single dime in the government, it would take us a very long time just to recover where we're at. So it's a pretty safe guess to say that going forward in the future, there's a very good chance that the government is going to raise taxes. So let's talk a little bit about how taxes work. So if we look at the tax brackets, and let's just say we're married filing jointly here, and we're at $220,000 in gross income. This is an accumulation of our W-2 and 1099 income, capital gains, these types of things, maybe business income, rental income, all go into your gross income. Then we get our deduction. We might be itemizing, but let's say our standard deduction is $25,009. If we calculate that, our taxable income is $194,100. Now, we have an increasing tax level, each level of money that we have. So if you start on the $0 to $20,550 of that $194, it's taxed at 10%. So your tax on that is $2,055. And it's important to understand that we're only talking about federal tax rates here. We have to put the state, for whatever state that you're in this as well. And they're also progressive tax levels. So between $20,551, it's 83 at 12%, which is $75.60. Between 83,551 and 178,150, it's 22%, $20,812. And between 178,151 and the 194, it's 24%, and we paid $3,828. If you combine those federal taxes there, they come out to $34,255. If you divide that number by your gross income, you come out to an effective tax rate of 15.57%. Now, it's important to add in your state rate there so you know what your real effective tax rate is. But going forward, what we would see in here is we would see that comes out over here at this. So it's important to understand that when it comes time to take money out of our tax deferred account, we must be taking it out at a lower rate than when we put it in, or we lose the game. So that being said, we go out over here. So there's some serious things to consider in this process of contributing to these qualified accounts. And make no mistake, if you have a qualified account such as a 401k, a 457, a 453, and they're doing matching, then you probably should be doing up to the match, because what's really happening is they're helping to offset that tax liability going forward. They're paying your future taxes. So most people should be contributing to their 401k, 403b, 457, whatever the plan is, whatever ERISA plan it is, up to the amount that their company matches. Now, beyond their match, well, that's open for debate. So, plans offer little or no access during accumulation period. So what does that mean? It means they lock down this valve. You cannot remove money from there without paying penalties. You can borrow money out of an ERISA plan, which means you can borrow up to $50,000 in any one period over an entire lifetime. But here's the problem. If you lose your job, you have exactly 60 days to pay that back, or it becomes a distribution, which means it becomes taxable. And then in addition to that, if you took it prior to 59 and a half, there's a penalty for taking it out. So that's kind of like an insult to injury. You've lost your job, you've lost your income, and now you have to pay a bunch of taxes because you took a loan from your 401k. When you hit the new age of 73, it used to be 70 and a half. When you hit the new age of 73 or 75 for some of you, you have to take what are called RMDs, or required minimum distributions. If you don't take those required minimum distributions, there's a 50% penalty. And in addition to that, if you take money, as I already stated, prior to 59 and a half, you're going to pay a 10% penalty for taking that out early. Now, all of that said, the real question comes, should I put money in a tax-deferred account? And the answer is 100% based on what is your exit strategy. How do you plan on getting the money out? And here's what most people believe. Most people believe that they should be putting as much money as possible in a tax-deferred account so that they can save on taxes today, because they're going to be in a lower tax bracket later on in life. Well, little piece of news for you. In order to retire, you must have one thing, and that one thing is a paycheck. You're not retiring without it. And for most people, their paycheck is going to be Social Security if they're lucky enough to have it, possibly a pension, maybe some rentals, maybe some business income. And those would be what are called their known incomes. Then they're going to have a need. This is going to be the amount of money that they absolutely must have in order to live their lifestyle at the level they've become accustomed to, adjusted for inflation and taxes going forward. Between their known income and their need, they're going to have a gap. And that gap is going to be filled by all the assets they managed to accumulate since they started putting their money away for their retirement. Most of that money, for most people, is in a qualified account. Now, the interesting thing about all of those things that are going to create that income, the IRA, the Social Security, the pensions, the rental properties, the business income, is they're all taxable. And most people are quite surprised when they sit down with me to find out that when they hit retirement, not only are they going to be in the same tax bracket, often they're going to be in a higher tax bracket. And one of the things that they rarely calculate for is the fact that one of them will die, and now they have to file single, and they're almost guaranteed to go to a higher tax bracket. So the question comes, are you planning your retirement or the government's retirement? Do you have a relationship with someone in the government where you're dying to give them your money rather than keep it for yourself or your family? Your goal should be to create an income stream that you cannot outlive no matter how long you and your spouse live, based on what your current lifestyle is, adjusted for inflation and taxes going forward, and pass your money on in the most tax-favored way to your heirs. The only way this is ever going to happen is if you sit down now and you start getting proactive and you start creating a plan on getting as much of that money to tax-free as you possibly can. I hope this video was helpful. There are plenty more out there to watch. Be sure to subscribe to our YouTube channel below. And remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. I hope to see you soon. Keep smiling and make it a great day.